and start another one. Welcome everyone to another portion of Mentorship Monday. We're going to get a lot of content today. Hope you're ready. For the rest of the day, we're going to chat about options. We've been going through, and you guys just saw that first recording. I was looking for day trades for the last 2 hours. 2 hours of chatting nonstop. I finally got a job where I could just chat all day. Couldn't find any day trades. So what we want to do, I guess at this point, is chat options. Now, many of you here, and again, don't be afraid to type it in. So let me get an idea. I could just do a poll, but type in a 7 if you're brand new to options. You have really no idea what they are. All right, so a bunch of 7s. That's cool. No worries. So let's chat about them, and I'll give you as much information as I can. First and foremost, let's cover the basics. Now, again, I do have a lot of videos out there about the basics of options under real life trading, as you guys might know. But since we're here, and I'm the one that made the videos, let's just remake them. When I'm first teaching someone about options, especially let's say I'm in a dinner setting or at a party or playing poker or watching a football game, that's when normally I start talking about trading at some point. I talk about insurance. So you can buy home insurance, you can buy car insurance, you can buy phone insurance, you can buy life insurance, you can buy health insurance, you can buy just about pretty much any insurance you want. Can you buy stock insurance? What do you guys think? For those who typed in 7, yes or no? If you can buy all those types of insurances, can you buy stock insurance? And the answer is yes, you can. Sure. The answer is yes, you can indeed buy stock insurance. So stock insurance is called stock options. Stock options, those are insurance for stock positions. And they were created in the 70s, I think 1973. Somewhere around there. And they were created in the 70s, and they are insurance for your trades. That simple. Now, remind me the 2 types of ways you can trade a stock. You can go long stock, and you can go short stock, right? The 2 different types of trades you can do. You can go long, you can go short. This is bearish, and this up here is bullish. So if you want to buy insurance for your long stock position, there's a type of insurance for that. And if you want to do insurance for your short positions, there's a type for that. So we'll break it down in just a second. But as you know, if you want to insure your house, that's an entirely different type of insurance. Type in 1 if you guys know that. If you're going to buy insurance on your house relative to your car, that's 2 totally different insurances. They might even be in different insurance companies. But it's a different type of insurance, it's a different payment, it's a different coverage, all of it's different. Richard says, invented in the 70s as traditional options in the London Stock Exchange, which are different to American options you trade. You can Google it for the difference. Yep. So there are 2 different types of options. I don't have a lot of familiarity with English style options or European style options, as you can imagine. But yep, there's a little bit of a difference. So this one, I guess you're totally correct, Richard. This is the one I'm explaining is going to be the American style options on the U.S. Stock Exchange. Great job bringing that point up. So since you have house insurance, you have car insurance, 2 different types of insurances. If you are long a stock, you're bullish, and you want to buy insurance on that, that is known as put options. And if you want to buy insurance on a short position, that is called calls. So those are the 2 types, puts and calls, and that's it. There are only 2 types. That's all you have. So if the stock goes down, like it did in the last 2 weeks, do you think the put options went up or down in value? If you're insuring something, right? And the value of the thing that you're insuring decreases, that insurance becomes more valuable. So the put option would go up in value during this blue part of the market. What about this purple part of the market? The purple part of the market went up. If you were short the stock and you had insurance, your calls, do you think your calls went up or went down? During the purple market, the calls increase in value. And also vice versa. So the put would have decreased in value during the purple market, and the calls would have decreased in value during the blue market. And really, at the end of the day, that is the basics of options. Options are stock insurance. That's all they are. The biggest difference of the stock market options is you do not actually have to own the underlying instrument in order to trade them or to insure your product. That's the biggest difference. What I mean by that is very simple. In order to buy house insurance, the vast majority of the time, you actually have to own a house. You can buy renter's insurance if you're renting, but if you have car insurance, you have to own the car. Can you buy insurance for someone else? You can. Why would you do that? There's reasons. But on a stock, you do not have to have the stock to trade options. I'm going to repeat that 2 different times during this session, but you do not have to have the stock to trade the options. You can simply trade these all by themselves. You are trading the options themselves. That's all you're doing. Just trading the options. So if you want to make money in a bullish market, what type of option would you buy? If you want to make money in this type of market right here, what type of option would you buy? You're going to buy calls. If you want to make money in a down market, what type of option can you buy? You're going to buy puts. And at the most basic level, that is options right there in its most basic form. Here's the interesting thing about options. There are variances of buying and selling options that you can combine to create almost an endless amount of strategies. So remember, in the stock market, there's only 2 things that you can do. There's literally only 2. You can buy long positions or you can sell short positions. Once you buy it, you have to sell it because you're already in it, or you can sell it if you don't own it and then you can buy it later. It's the only thing you can do. You can buy or sell, long or short. That's it. That's all you can do. Game over, done. In options, there are thousands and thousands of variables that you can do. And that's why it can start confusing traders at some point, because that is a road that is endless. Or at least it will take you years and years and years to master it. To put it to you lightly, I probably have mastered about 60 option strategies, and there are hundreds that I have very little idea of how they work unless I look at the charts for a long time, and there are probably other 100 or 200 other strategies that I have never even heard of yet. So there's a lot of them. You can combine them in numerous ways because there's an endless amount of variables. And in its most simplest form, this is it right here. If you want to make money when a stock is going up, you can buy calls. If you want to make money when a stock is going down, you can buy puts. That's its most basic form. Remember, the market rewards the specialist, right? So if you want to get good at one thing, that's my suggestion, is to find that one thing, understand it, and get really good at it. Type in a 3 if you have ever been an insurance salesman, salesperson, in a sales position. If you've ever sold insurance of any kind. No one. Oh, okay, cool. All right, so just me. That's fine. Okay, I'm getting a few. All right. So a few typed in now. So if you've ever sold insurance, you should understand this next part that I'm about to talk about. If you buy insurance, then it would only make sense that you can sell insurance, right? That makes sense. If you can buy insurance, then someone's selling it to you. Just like if you're buying car insurance, you are paying some agent or some company premium. That's a very important term to remember, premium. You're going to hear it a lot. Premium is the amount that you spend as a debit when you buy. Would you all agree on that? And premium is the money that you get in as a credit when you sell. The way insurance agents make a lot of money is they sell a lot of insurance to a lot of people, and every month and every year when their policies renew, they get credits. That premium just slowly compounds over time. It doesn't start off very gloriously, but at some level, after 5 or 6 years, you can build up a nice little base of customers, and you can just get that monthly recurring revenue every single month. Mailbox money, so to speak. So if you can buy insurance, you can sell it. This term premium is very important. Premium is how much most of you are going to buy options for, how much you're going to spend. So let's do an example really quickly on SPY. Let's say that I wanted to buy a call option on the SPYs. And I wanted to buy a call option if the SPY breaks above the high of today. Once I understand my analysis, I then have to come up with my time frame. Remember how I always say that that's going to be one of the biggest things that you want to look for in trading is your time frame? Probably the number 2, number 3 thing you want to figure out when you're trading is what is your time frame as a person? What's your objective? What's your goals? Are you retired? Are you 30 or are you 60? You know, are you trying to create cash or trying to protect cash? Are you trying to generate income or build wealth? Are you trying to supplement your income from work, or are you trying to add to your income from work? Or what are you trying to accomplish with all this? I know we all want to make money. I get that. That's fine. But in what time frame does it matter the most to you? So you're going to have to determine your time frame, because when you trade options, options have expiration dates. Options have expiration dates. And that makes a lot of sense, because doesn't all insurance also have expiration dates? Yeah, they all do. They all have one where for life insurance, it's a little bit longer. Health insurance, you can pay yearly, monthly, quarterly. Car insurance every year, right? All insurance expires at some point. So you have to pick an expiration date on the option that makes the most sense to you, to your time frame. So they all have expiration dates. So what do you think would cost more? An option with a short or long-term expiration date? Which one would cost more? Which one would have more premium? Well, let's do an example. So let's look at the SPY. And to buy a call option on the SPY, a 263 call. Let's say if you want to buy a 263 call for April, you would spend $9 per contract. We're going to get to this in just a little bit, because we're really going over the basics right now. So if I wanted to do April, that is $9 per insurance contract. If I wanted to do January 2018, same exact call option, well, not the exact same call option, I probably should have done 265, but you guys will get the idea. The long-term January is going to cost $18 per contract. So the more time you buy, the more it's worth. but the more time you have to be right about the trade. That's exactly what Marta says. So when you buy a short-term option, you can buy it, it's a little bit cheaper than the longer-term option, but the longer-term option, you have more time to be correct. Any questions so far? Yeah, basics. This is the basics. We're going to get a little bit deeper as the day goes on. All right, so it sounds like you guys are good so far. If you have any questions, let me know. The way you do the pricing of options is per 100 shares. Because remember, these are contracts. These are insurance contracts. You have to insure something. So you're buying them per 100 shares. So when you see an option value, when you see this is called premium right here, when you see the option premium, that's how much your insurance contract is going to cost. It's cost times 100 shares. So if I want to buy one contract of April, it would cost me $900. And if I buy one contract of January 2018, it would cost me $1,800. Simple math. This is first grade math. So let's test you guys out. If I wanted to buy 2 contracts of April, how much would it cost? So 1 contract is $900. How much is 2 contracts? $1,800. There you guys go. Nice job, Sandra. You're getting it. So that's the pricing. This is just first grade math. This is easy. Nothing too crazy right now. Here's what's exciting. Let's say I buy an April call today, which is Monday. Today is Monday. And tomorrow it goes up to right here, Tuesday. Can I sell the 2 of these April calls that I bought for $1,800? Would I be able to sell, yes or no? The answer is yes. Yeah, so option contracts are just like stock. You can get in and get out whenever you want to. The vast majority of the time. If there's enough volume, right, we're talking about buying long options, you should be able to get out and get in the vast majority of the time. To date, I've never had one issue selling an option that I bought. And so over 10 years, every time I bought an option, I've been able to sell it. So you can sell an option within seconds, minutes, hours, days, weeks, whatever you want before expiration. So you can buy and you can sell whenever you decide. It sounds like to me, if you can sell whenever you want, you probably would want to have some type of rule, right? Just like trading, you want to have some type of quantifiable metric that determines when you buy and when you sell. That's part of your plan. Because that's what Bob says. Sell at what price? There you go, Bob. I just answered your question. That's up to you, my man. It's up to your plan. It's up to your analysis. It's up to your interpretation of the chart, what you're doing, what your purpose is, what your time frame is, all of that. That's entirely up to you. Because if I buy a stock at $1, I can sell it at 2 and double my money. I can sell it at 3, 4, 5, 100, 1,000. It's entirely up to you. David says, for this example, which one would be more profitable, the option trade or the actual stock minus commissions and margin impact? Profitable? Let's do the math. So let's do some math and find out. So if I bought 2 contracts of April, that's controlling 200 shares of stock. So we're going to do 2 shares and 2 contracts. So 2 contracts would cost about $1,800. And if they trade up to here, they'd be worth approximately, let's see, 9, 5, about 12 each. So it'd be worth about $2,400 approximately. I'll show you all that math a little bit later today. We're getting there. Okay, and if you bought 200 shares of stock, well, that's really easy to do the math on that. If you bought it at 263 and you sold it at 268, let's just call that $5. $5 times 200 shares equals $1,000 of profit. All right, options are shares are very easy to calculate. So profit, you made more in the shares. But your investment was only $1,800 and you made $600. Your investment on the stock to make 1,000 would have been about 52 grand. So your ROI on the stock trade was very small. I shouldn't say very small, it's not bad, but it's not great. The ROI on your option trade was like 30%. The ROI down here was like 0.5%. No, 1%. 1,000, 2%. Why is my brain not working right now? 52,000, $1,000 of profit. That'd be a $500 R, 2%. So 30% ROI versus 2% ROI. We know which one has greater return on investment. I can tell you almost assuredly you will always make more money trading the actual stock. And what I mean by that is pure profit. You will make more money profit on the stock than the option. Because what I'm going to do is I'm going to paint, for the rest of you watching this recording, I'm going to paint a very pretty picture of options, and I'm also going to paint a very terrible picture of options at the same time. Like your kid drawing a painting of Mona Lisa. It's probably going to be pretty bad, but your kid drew it, so you'll think it's pretty. So we're going to do that type of discussions because that is going to be a very important thing to know. So this is very beginning. This is very basic. This is just simple math at this point. We're going to get more into it. But that is really the beginning of option trading. Now, each option has different expirations. So let me go over to Thinkorswim. Okay. And here is the option chain right here on Thinkorswim. This is the option chain. So this is for SPY. And so what you'll notice is they have a bunch of different expirations. These are all the expiration dates. So if you get enough stocks, if you get the right stock, you should have an expiration that expires pretty much every Friday. So there are some stocks that do not have options. There's actually a lot of them. There are also some stocks that have options, but they're really pretty terrible. As someone was mentioning earlier, they have bad bid-ask spreads. They have very low volume. They're not that great. Think about options just like numbers on a screen. They're just exactly the same thing. So there are some stocks that have options that are terrible. They have some stocks that don't have options at all. And there are some stocks or ETFs like SPY, which is very, very, very liquid. So SPY is one of those liquid opportunities. So let's talk, someone mentioned R value. So I want to get into R value very quickly in this discussion because that was the part that was left out to me when I first learned about options. I was taught how cool, exciting, and incredible they are and how much money you can make, but I didn't learn anything about the downside. So let's talk about that now. Let's say I go to March. Expiration. So what you're looking at right now is you're looking at an option chain. Looking at option chain. So this thing right here in the middle, This is just the expiration date. That's all. That hasn't changed yet. They say the same thing for every one of these. Notice this number right here where it says strike, S-T-R-I-K-E. All right, strike. That is the price of which you have the ability to buy and or sell the stock if you want to. To make it very easy for you all to understand, the strike is irrelevant and you don't have to even worry about it that much if you do not ever want to exercise the option itself. For 99.9% of you, for right now, don't have to worry about what the strike means. Just know that it does have a meaning and it does give you the option to actually buy and sell stock if you want it. But if you only want to trade the option, then it literally has almost no meaning at all. So don't worry about it because you can choose as many as you want. This purple outline here and this purple outline, these are called in the money options. This black outline and this black line is something called out of the money options. So those are in the money, out of the money, and then right at the middle is something called at the money. To make it a little bit more clear, these, oh boy, what did I just do right here? These are the options that you buy are the ones in the money. When you buy options, that's a terrible color. I thought it was, why is it blue? Let me try this again. Buy, okay. So these are the ones that you buy. These are the ones that you buy. These are the ones that you sell. And these are the ones that you sell. So if you buy an option, you buy it in the money. If you sell the option, you sell it out of the money. That means when you are getting into the trade. So again, for the vast majority of most of you, the only ones you're going to care about right now are when you buy them. We're going to get into selling a little bit later. I have plenty of videos on selling options. But when you want to buy them, you buy them in the money. Now, I know the screen's a little hard to see. I can always zoom back out and then make the font a little bit larger, but you can also zoom in on Zoom if you want to. But let's say, for example, this option. So what we're going to do is we're going to talk about the value of these things. So this option right now, how much would it cost at this exact moment in time to buy one contract? About 700, it's going to change. Let's just call it $704, not including commissions. Right, you have the bid and you have the ask, just like all instruments. You have the bid and you have the ask. You buy at the ask, you sell at the bid. This is everything. Okay, so you're going to spend about $704, not including commissions. So let's talk risk, because this is a very easy topic. No one ever thinks about it this way, but it's very, very, very simple. And then I'm going to blow your mind, and then we're going to talk a little bit more about it, and we're going to be done. I have lunch, and then we'll come back and talk more. So here's how easy this is. What if your R is $100? If your risk is $100, where would your stop go on the option? Well, if it costs you $704 to get in, then your stop should be $6.04. You guys following that math? That's pretty easy because you bought one contract. So if you bought one contract, you spent $700. So $700 minus $600 is $100. Dean says, you aren't making a video? I am making a video. Yes, sir. I'm recording it as we speak. Trick says, you need a bigger R for this trade. Not necessarily. You can take this trade with $100. You can take this trade with $25. So let's say that. Let's say that you buy this trade with a $25 R and you purchase it for $704. One contract, $100 R. Where would your stop go? Remember, this is first grade math, folks. You're 4 years old, 6 years old, 5 years old when you learn this. One contract, sorry, I said $100 R. I'm sorry, I meant $25. Apologies. $25 R. So I'll let you guys redo the math. Dean says, do me a favor when you get a chance. 3R in the bank with Lumber Liquidators Expedia, 3 hours before noon, send me packing. Well, it's 11:30 Eastern, so Dean, get out of here. I love you. Go play disc golf. You're a hero, and I want to be more like you when I grow up. We got one answer for the number, which is correct. Anyone else want to take a shot at this? Very easy. Where would you put your stop if you only want to lose $25 on this trade? Martha, we're going to get that in just a second, but it's tricky, but this is simply math at this point. We're going to get to it in a second, but this is mathematically how you do it. The stop would be $6.79. Not including commission. That's correct. $6.79. That's it, guys. That's how you place your option. Pure math. Now, Martha was saying stocks are tricky with options because you have a lot of whipsaws. It's absolutely correct. It's very, very accurate. Just because you can set a stop on an option doesn't mean that it'll work out. Now, again, if you don't care about losing, and you go, all right, I'm going to set my entry and just walk away and let it do its thing. I mean, this trade could easily go to, if $6.79 is your risk, this thing could easily go to $8 today. No problem. I don't know if it will, but it could. And if it goes up to $8, that would be like a 3R trade. That's just, again, simple math. You're just basing it on the numbers, similar to anything else out there. Now, again, just because you can, does that mean that you should? Well, what I'm about to show you is something that helped me dramatically with my option trading. This is probably going to be the most important part of this video. I'll be talking about this the rest of the day. But I get about 47 emails a day saying, Jeremy, how do you determine your option prices? Well, there's a really, really easy way to do it, at least in Thinkorswim. There are other platforms where you can do this, and I will show you all of those today. Well, not all of them. I'll show you another way to do it. Interactive brokers, you can do this in. Yahoo Finance, you can do this in. Options Express. Most brokers have what I'm about to show you. It's called an option pricing chart. So follow this very closely. E-Trade, yes, E-Trade has it. I don't have an E-Trade account, but E-Trade does have one. So you have to do this from the option chain, but I go to this option chart and I right click. Okay, so again, this isn't Thinkorswim. Remember, you can get a Thinkorswim platform and you can deposit like $2 in there and you can keep it forever and you don't have to trade with it if you don't want to. So if you have a broker that you like that does not have this accessibility, you can get Thinkorswim. It doesn't cost you anything. Maybe it costs like $1 to put money in there so they don't freeze your account or whatever. And you can go do this with this. Grongi said, you don't have to deposit anything. At least I didn't. Well, there you go. So you don't have to deposit anything if you don't want. So you can do this with Thinkorswim even if you don't use Thinkorswim. But you right click, you go down to where it says copy. So you click on copy. And then you go up to a chart tab, right? So this is all it is, just click on charts. I went from trade to charts. That's all I did. Trade, clicked on charts. Now I have two charts here. Most of you might only have one chart. If you have one chart, that's fine. Okay. If you have two charts, this is what it looks like. You can have three charts. You can have as many charts as you want. You guys all know this. So let's just do one chart for right now. And what I'm going to do is I'm going to come up to the top ticker where Apple was. I'm going to paste what I just copied. I'm going to Command C or Command V or Control V, or you can right click and you can paste it. You guys all know how to paste at this point. It's 2018. Paste it into there and you press enter. And this, my friends, is an option pricing chart. This shows you visually the price of the option on whatever time frame that you're looking at. This right here is an hourly chart. Now we're going to zoom in just a second, but I do want to reiterate that this option pricing chart works with only a few stocks well. If it has options, you can chart it, but you very, very rarely get good data the lower and the lower that you go. Because think about it. In order to access all this data, I think it's like 1.5 terabytes per day that TD Ameritrade has to store. A terabyte a day. Because this option chart is changing just like stocks every single second and on all of them. Class, does an option chart match the stock chart on the same time frame? Yep, it does. I'll show you that in a little bit. So this is an hourly chart of the chart that we just looked at. This is why I hate Thinkorswim. Got to adjust it every time I want to do this chart. So this is the hourly, and here's a 5-minute chart right here. Got to adjust it again. Okay, so this is a 5-minute chart of SPY. This is the call option that I selected right here. Just like you have candles on a stock chart, you have candles. You don't necessarily need this. I don't even know why it's there. It's just a theoretical option price, it kind of defaults. Okay, so here we go. This is a 5-minute chart on this particular call option. Which means if you were looking at some of the candlestick analysis and you go, okay, cool, I want to buy right here. This price is $4.50. And it tells you what the low price was $3.83. So let's say that you were looking at the stock chart, like Clive mentioned, and you said, okay, based on my stock chart, I want to get in bullish right here. And you got in bullish at 450, okay? And you have the low of 383, maybe you place your stop at 380. You now, my friends, have your stop value. If the low is 383, you want to put your stop at 380. 450 minus 380 equals 70 cents of difference. Now you take whatever your R is, divide it by 70, and you have how many contracts you can buy. And you can visually determine that on the chart. You can look at it just like you look at the stock chart and figure out where the stop should go on the option price. Is that cool or is that cool? Here's the funny thing is the vast majority of people have no idea this even exists. It's weird. It's very easy to use. So let's say your R is 200 bucks. Then you take $200 and you divide it by 70. 200 divided by 0.7 equals 285, and that is shares. So if you're going to buy contracts, how many contracts would that be? That would be 2 or 3 contracts because you cannot buy partial. So it's either 2 or 3. You get to decide. If you buy 2 contracts, you're not going to lose your full R, usually. And if you buy 3 contracts, there's a chance that you can lose a little bit more than an R. Now, as I mentioned earlier, there are numerous ways to trade options. So many ways. Oh my goodness. So many ways. One way that I suggest when I'm trading options is you obviously look at the stock chart and determine a good value, but never forget the ROI. Never forget the ROI when you're trading options. What do I mean by that? Guys, do you guys think a 20% return on an investment is a good investment? Is 20% good? Yeah, it's pretty good. You can make a 20% reinvestment on options with your eyes closed. For example, if you had bought the option at 450, okay, and the option went up, 45 cents is 10% return. So 90 cents. So if this option goes up to 550, that is a 20% ROI. That's a 20% ROI. If this option goes from 450 to 550, that's 20%. And it did that in about an hour. It went from here to here in an hour, 20% return. Which means you can go out. Jose says, how do you calculate the percentage? So this is just the math portion of it, Jose. So let's say, what's 10% of a dollar? One of the tricks that I use, that I was taught in school, is take the decimal and move it to the left. That's one of the tricks, right? So 10% of a dollar would be 10 cents. All right, so what's 10% of $44.50, Jose? 10% of $4.50 would be, move the decimal place to the left, 45 cents. All right, so if you want to do 20%, then just multiply that number by 2. So 45 times 2 equals 90 cents. And then you add 90 cents on top of the 450, and you'll get 20% return. And that works with any option. That works with any stock. That's just easy math. Yep. He says, got it. All right, perfect. Yeah, so that's, again, a great question, but very, very simple. And you can practice that over and over. But what's phenomenal is I tell people all the time, I'm not very good at math. I know, fourth grade math. I know percentages and multiplication and adding and subtracting. And that's, if you can do that, you're pretty much good. That's when I got into algebra class. I was asking my teacher all the time, how do I make money with this? Because I couldn't figure it out. I knew how to make money with percentages immediately. I was like, okay, I get that. If I buy this 20% cheaper and sell it 30% higher, right? But if I'm doing algebra, how do you make money with algebra? I don't know. And the teacher couldn't explain it to me, so I didn't really care about algebra. If the teacher had showed me how you can make money with it, which there are ways, I would have been much more intrigued at that time. But I never got it, so I know how to do algebra. It makes sense. I don't know the applications of it. But that's another discussion for another day. When I come back to the 20% thing, I'm not saying that you have to sell at 20%. But what I am saying is, with options, if you are buying them, you can sell them whenever you want. What would have happened in this trade, had you $4.50 and you had a stop down here, you actually could have sold them this morning for almost a 100% return on your investment. You bought them at $4.50 and they were worth $7.50 this morning. So let's call that an 80% return on your investment. You bought some calls Friday, you sold those calls this morning, and you're done. 80% return on your investment. So again, it's one of those things with options that, do you go for R's? Do you go for percentages? As Ian's mentioning, that's entirely up to you to just kind of determine your own plan. What I have found out a vast majority of the time is you can easily do a 2R, right? So let's say you enter here with a stop here. 2R would have been right about there. Still a very good trade, right? Still really solid. Everything is good, thumbs up. Still got 2R. But what if you don't hit your 2Rs? And time is ticking down, or it happened immediately. Like, what are you doing at this point? You don't have to hold overnight. Like, what's the goal? Yeah, 2Rs is great. Why not? 2R is fine. But again, if you're looking at an option trade and you're looking at it and the trade's not really working and you're up 20% on the option, maybe 20% is not your R, or maybe it's not half an R or whatever, but if you're up 20% and let's say you got into the trade and it's just not really working out as quickly or as nice as you wanted to, just exit the trade and take your 20% return. I mean, 20% return in hours? Come on, guys. There's no other place in the world. Options are the greatest return on your investment potential in the world. There's nothing that moves like options. Nothing. Cryptos are phenomenal. Love cryptocurrencies, but not even they move like options. Bitcoin did not move 85% in the last 48 hours. So yeah, take your money and run. I mean, you're going to have to build a plan with options. And that's, again, folks, there's no mythical creature that you're going to hop on the back of and it's going to take you to the profit kingdom. Okay? You have to create a plan just like everything else and trade it just like everything else. A quantitative, this is what I do, this is when I do it, this is why, this is all that stuff. Options go as deep as you want it to go. Stocks, not really. You can buy or sell them. Options, you can buy some, sell some, have different legs, different expirations, different sizes, different quantities. You can have a back ratio, calendar, inverse, debit spread. You can do all kinds of stuff. Broken winged butterflies, iron condors, jade lizards. There's so many crazy names for these things. You can go on and on and on. Long call diagonals, bear call spreads, bull put spreads, ratio spreads, ratio back spreads, bear call spreads, bear call ratio spreads, naked options, covered options. It goes on and on. James says, never heard of the jade lizard. You never heard of the jade lizard? Oh my gosh. You do the synthetic long, double synthetic long. Viral says, can you analyze the weekly options newsletter trade? I can. Yep, give me just a little bit. I'll do that for you. Any questions so far while we're hanging out here for a bit? Any questions? Let me pull this up over here. Great. So far, some great questions. Efren says, I like to keep it simple and stick to calls and puts. Yep. So Jose says, so you said a stop loss with options? Yes, sir. That's kind of what we've been talking about, right? Just a few moments ago, you can set your stops based on your risk, just like everything else. Absolutely want to set your stops with options for sure. Bray says, at what point should we get into this part of trading? Which part? The insane options, like all kinds of stuff going everywhere? Options at all? In my opinion, if you want to get into options and start learning about them, is when you've traded stocks profitably. It's when you've traded stocks profitably. If you can trade stocks profitably and you've already made money trading stocks, then you can start hopping into options. If you haven't, I wouldn't. Very good question. Yep. All right, so let's go look at the micron technology trade. So what I'm going to do is I'm going to go to charts. I'm going to open up two charts. Open up two charts. I'm going to type in micron over here. So this is the daily chart on micron. Everyone cool with that? I forgot how to set this up to the right, but so this is the daily chart on MU. So let's go over to MU. So remember, I got out of this particular trade on MU, but we wanted, this is the weekly options newsletter trades. We wanted to buy the $42 call expiring February 23rd, and this was the option chart for it on an hourly time frame. So here's the hourly time frame. Let me zoom back a little bit. Put this in here. Give me a second. Gotta get it all nice and pretty. Gotta take this off. Remove. Yes. Kind of scrunch it in, make it a little bit prettier. Change this over to here, and so I can use this guy. All right, perfect. So this is the hourly chart. So I'm gonna hop over here and go over to the hourly chart. And what you'll notice, this might be a little bit hard to see, but do you guys see the left-hand cursor? Do you guys see that moving? So the cursor on the left is moving, it's tracking with the stock price on the right. You guys can see that. Okay, perfect. So you can track the stock price and figure out where the actual option price is as well. So here's the hourly time frame. And I'm trying to make it look pretty for you guys. Let me move this over here. So there's a lot of different ways to play this particular trade on MU. I just liked MU because, well, it looked pretty at the time. So if I'm looking at the option pricing chart, there was a support right here, and there was a support right here on MU. Now this was the exact trade. That trade happened earlier. It doesn't look like it looks now. Let's say I wanted to take this trade, right, based on the support level on the stock chart. So remember that. I'm looking at my stock analysis. I do my analysis on my stock, and then I hop over to the option trade and I figure out what I want to do. So let's say I wanted to buy this option and I buy it at $1. I have a really cool strategy for you guys to ensure that you never, ever, ever lose more than 1 R. You guys interested? I shared this exact strategy on Slack not too long ago. And to my knowledge, there's not very many people who talk about this strategy, if any at all. I know no one has called it this because I created the name for it, but we call it the absolute zero method. Absolute zero. So let's say, for example, my R is $100 and I want to buy an option at $1. One of the things that you can do is have absolutely no stop on that option at all. And your investment is your risk. I'll say that again. Your investment is your risk, your entire investment, meaning you're willing for that investment to go to zero, but in doing so, you're only going to risk your 1 R. So for example, if your R is 100, how many contracts would you buy at $1? You would buy 1 contract. What's the lowest that the option can go, ladies and gentlemen? 0. It's impossible for it to go lower than that. It is literally mathematically impossible. Can't happen. We're not into the realm of theoretical numbers, no imaginary numbers. It's 0. Once it gets 0, it's done. Now, the problem that most traders do is they buy way too much and then they let it go to 0. Right? So what a lot of traders will do is their R is 100, they'll buy 10 contracts and they'll let it go to 0, but that's $1,000 worth of risk. You guys follow me so far? So if you buy 10 contracts at $1, you're risking $1,000. If you let that go to 0, that's a much, much bigger R than $100. It's all about how many contracts you buy and at what price. What if your R is 400? How many contracts could you buy at $1? 4. Yeah, exactly. And I think you guys are starting to get it. So I do a lot of my trading this way with options because I can guarantee that I cannot lose more than an R. And then what I will do is at some point, I will increase my stop. So let's say I got into this trade on Micron, which I did not, but let's say I did, and my stop was 0. Do I have a visual spot where I can now increase my stop if I want to? And I would argue, yeah. It says it right here, low of 48. So I could put my stop at 48 cents. I could put my stop at 50 cents, 25 cents, somewhere around this area. I can move it up to here if I wanted to. I can put my stop anywhere I want to now. And that would signify that there's no way I can now lose an entire risk unit. It's impossible. And that's all trading is mitigating your risk. Frank says, when do you get out? How do you know when to get out of a trade? So Frank, again, that comes down to your plan, my friend. Come up with some rules for yourself and see if you can follow them. Those rules can be anything. So if you're trading an option trade, your rule could be, all right, I always exit when I have a 30% profit on my investment. What do you guys think? Will that rule work for you sometimes? Absolutely. What if the option goes up to 35% and then it rolls over and you didn't get out? Is that my fault? No. Whose fault is that? Yours. You're not disciplined. I'm sorry. Right? So hello, right? I mean, the goal is you guys got to create your rules and then you got to follow them. I like the 30% rule. I'm a big fan, honestly. I mean, 30% return on investment is solid. If I'm not at 2 R's in like 2 or 3 days, like if I get into an option trade, these things should work quickly. I get in, I get out. Simple as that. You need to make money. That's what I want to do. When I'm trading an option, I don't care if it goes to my target, guys. Options aren't designed to trade to your targets. That's what I do with my stops. For me, I have targets set, 2 R's, great. If it hits 2 R's in a day or two, awesome. But if I start seeing weakness, if I start seeing market weakness, if I see something going weird, I'm just going to exit out, especially if I'm at 30%. I mean, 30%? You can get 30%. Guys, this option that we're looking at right now has gone up from $1 to $1.30 today. Jose, what kind of return is that? That's 30% return, my friend. That's a 30% ROI in a matter of 2 hours. Where in the world can you do that? Options. That's it. It's the only place. It's phenomenal. Now, again, I'm going to paint a good picture. I'm going to paint a bad picture of these things. Bad picture will come up later. That's a 30% return. Fantastic. Beautiful. I tell people all the time, it's all about your risk. Because if we pull up one stock, let's say we pull up a stock, I'm going to pick a random one, BIIB, and I come into this option, and I copy it, and I go look at the BIIB chart. So this is me coming up and pulling up this option chart on the hourly for this stock, and this is the data that you have, folks. See this one? Not a lot of data. In fact, almost none. Why is that? Volume is very low. You're not getting any option price. I mean, right now it's trading at about 750, but there's very, very, very little volume going back and forth, and there's just not enough for Thinkorswim to pick it up. Does that make sense? So some options, I mean, some stocks you probably shouldn't trade options on. In this situation, what I would do is I would go back to a March and I would see if there's any data for March. I go, okay, well, there's no data for that week. So let me go back to another week really quick. And okay, this one I have some data. But you see it's still not very good. Can I see that? It's like, it's a little all over the place. It's very sparse. Again, this is the hourly chart. So you could change this by changing a different setup, but this is the hourly time frame. And you see how the low, it says 7, and it's at 1180 right now. So that's a $4 spread. That's pretty large, pretty large. So the more expensive stocks you go, the harder it is to play absolute zero as well, because they're just really expensive. Again, if the stock doesn't have a lot of volume, it'll look a lot like this. But if you go to something like Apple or whatever, or Google or Amazon or Facebook, let's go look at Facebook. You go look at Facebook, you'll have much better option charts. And that's why I only trade certain stocks with options. Look at that. Much better. Oops, sorry. Let me reset the chart. Turn this off. I don't want the theoretical option price on there. Yes. So if I come in, here's Facebook right now, the hourly. Look how much cleaner that chart is. Ray says, Jeremy, what happens when you cannot sell a put that you bought? Like 3D printing, February 16th, $8 put on Thinkorswim. So I sold that put. I didn't buy it. But if you bought that particular put and you can't sell it, then it usually goes to zero. It'll expire worthless and there's nothing you can do. It's a little bit more on the rare side, but it certainly can happen. So if we're trading Facebook with this option, ladies and gentlemen, what value could we use for a stop? What value could we use? And $5 could be a value that you could use, right? Because that's lower than we've gone before. And right now it's at about 721. So if you bought, let's say you want to buy at 7 on a pullback and your stop is 5, and let's say you have an R of 200, how many contracts can you buy? 1. You can buy 1 contract. All right, what if you have an R of 50? Can you take this trade? Not with that setup, you can't. You have to do something a little different. So you can pull up an option pricing chart and view the setup for it. You can get a better understanding and a better idea of exactly what it is that you're looking for. Speechless. I love it. What questions do you guys have? I got 4 minutes before I go to lunch. What I will do is I will pause the recording before I go to lunch, and then I'll put on another options video for you guys. While I'm gone, I'll put on another one that I have, and then I'll come back, answer questions if you have any, and then I'll record another hour, and then I'm going to go. Anything? Gronga says, could you share the link for the absolute zero trade because I got lost in the explanation? I will put that video on for lunch then, and then I will share the link. Let me just go ahead and do that now. Okay. All right, well, I'll stop the recording. For those who are watching all the way through, thanks so much for being a real life trader. I appreciate it. You were awesome. Let me get that.